Hey guys, so I'm going to be going over options today, and I just want to warn you guys, this is a good video to watch, but I would not trade options yet until you can trade shares, because if you're not profitable in shares, you will blow up your account with options. I did the same thing when I started, so yeah, and if you want to paper trade options, make sure you guys download Thinkorswim. You could day trade options on the app, but you need to make an account. You don't have to deposit anything. You can just paper trade options in there. So I'm gonna be telling you guys, I've only been trading options since like August. So I don't know anything about like the iron butterflies, or there's like other options you can do, like covered calls, covered puts. I know a little bit about those, but I don't do those. I'm gonna be just going over calls and puts because that's what I do, and you can be very profitable in calls and puts if you know what you're doing. And I'm gonna go over the stuff you need to know about options, but I'm not gonna go over everything you need to go options. So keep that in mind. So starting off, how do you read a contract price? So if we go to my Twitter, let me go to Twitter real quick. Let me try to find an options alert for you guys. You guys probably see options alerts on Twitter. I'm assuming, like if you follow Profitsy, I'll show you guys what the format is like, because some of you guys probably have no idea. And you can skip this part if you already know what I'm talking about. Alright, so here on his Twitter, we see him alert an option call. And this is the ticker name, so if you're on Webull, you type in the ticker. And then 26 November 21st, 72 call. So and he's saying the average price is 0.48, stop loss 0.38. So like a stock, you trade options in something called premium, and premium is basically just like pretend you're just trading a stock at 48 cents, but except this 48 cents actually means $48. So that basically, this is called premium. And if we go to ATVI right now, when we go to options, this is how you get the options. And say we go 1 week out. So if you look, the bid is at 0.61 and the ask is at 0.67, and this is called premium. This is not actual, like this is like shares, but it's called premium. So pretend this is like a share of a stock, except it's premium. And basically 0.61 represents $61, 0.67 represents $67, $39, $42, and you get the point. This would be $105. And the reason why that is because you're basically buying contracts that lets you sell shares. So if I bought 171 call contract for $61 right now, that means I'm basically buying 100 shares of this in form of a contract, and you do that through premium. So you do not need to know like what exercising means. Like people exercise these, so all that means is basically if they buy one contract of this, they could buy 100 shares of this of ATVI at $71. But I've never exercised. Not a lot of people exercise. People only trade them for premium. So if the stock goes up, you try to buy at $61, and then if it goes up, you want to sell higher. So like it'll go to $70, $80. So if you buy it at $61 and it goes up, the stock goes up a little bit, it might go to $70. So you can sell for a $9 gain per contract. So if you bought 10 contracts and it went from 0.61 to 0.70, that's 0.09, which is actually $9, and $9 times 10 is $90. So that's just the basic idea of it. And if we go back to this call, so he's earning ATVI 26 November 21st, and you guys need to know options expire every Friday. So as you can see, all these expired today, and all these expired, and basically options. So you want to know in the money and out of the money. This is in the money, and then we see this like black band that it separates all this. This is out of the money. So in the money, and in the money is basically just option strike prices that are under the actual stock price. So these numbers right here, they're strike prices. So like $69 and $68, $67, these are all strike prices. And basically in the money means is if the strike price is under the stock price, that means it's in the money. But if it's over, so see how $70 is over 69, good number by the way. See how it's over 69.69, that means it's out of the money. And as close to the Friday you get, these will go down in value, because if they expire out of the money, then they're worthless. You can't exercise them. And if you did exercise them, like you'd literally be you'd be buying 100 contracts of ATVI at $70, but you'd already be down 30 cents per the 100 contracts you buy. So why would you want to buy 100 contracts at $70 if the price is already less than that? That's just dumb. So if you're trading for the premiums, you have to understand if something's out of the money, they will decrease. If the stock price doesn't do anything or don't go down, they will decrease because they will become worthless at the end of the week. And as you can see, these are all the dates. So 12 November 21st, 19 November 21st, 26 November 21st. So this is the these are all the dates. So 12th, 19th, and they're all in increments of 7 because they expire every Friday. So 7, if you see this 7 day out, that means they expire next Friday. And we see the same prices or same strike prices. And as you guys get farther out, these prices will increase. So if we look at the 14-day 70 strike bid and ask, it's 1.37 and 1.46. But if we go to the 21-day, the bid and ask is 1.75 and 1.86. So that's almost a $40 increase. So this is a strike price. These numbers are strike prices. And basically, if you're looking at an options alert, this is the strike price right here, 72 call. So it's usually the number he puts in front of call and put. And this is the date, so 26th of November. And this is the average price. This is the average bid or premium price, and that is basically it. So that hopefully you guys understand that. There are more options videos to go over that. And if you didn't understand that, make sure to ask me questions, but it's pretty self-explanatory. So now I'm going to be going over calls and puts. So a call is on this side, and a call is basically you think the stock's going to go up, so you buy a call option if you think it's going to go up, and a put, you buy a put option if you think it's going to go down. So that's kind of like shorting. So these are all the puts on this side, and then these are all the calls on this side. So it's self-explanatory. Call means you think it's going to go up, put you think it's going to go down. And I'm going to start going over, or maybe next video. So I'm not going to go over everything today, but I'll go over the Greeks tomorrow. And I'll go over open interest and implied volatility and all that. But you guys just need to understand right now, these are the strike prices. This is the premium, and it's basically in multiples of 100. So 0.41 would be $41, 0.89 would be $89, blah, blah, blah. And then this side is the calls, and this side is the puts. And you can just go to just calls if you want. So these are just calls, and then you can just go to puts if you want. So say I think the stock is, so you guys probably have this question, and I'm going to explain this right now. So say you think the stock is going to 65. Do you have to buy a 65 strike price? Do you have to buy a 65 put? The answer is no, because depending on what day of the week it is, if it's like a Monday or Tuesday, and the stock price starts going down, say the 69 goes down to 68, and you have a 65 put option, the premium in this will likely increase. So like this 0.10 will probably go to like 0.20, because the closer to in the money it gets, the more that the premium price will rise. And just so you know, these are in the money for puts, and then these are out of the money for puts, and then these are in the money for calls, and then these are out of the money for calls. So in the money puts, out of the money puts, in the money calls, out of the money calls. So just so you guys know, out of the money calls and puts are more risky, but you can get bigger gains in them. Why? Because if you buy a option for a strike price of 68 while the stock's at 70 and it's like 0.45, it'll jump like 100% if it goes in the money, because once it's in the money, it becomes very valuable. And I'll explain the Greeks next week, but you want strike prices to go in the money, but I do not care if they're in the money or not, because I day trade options. So I literally buy an option. I'll buy a put or call, and if the stock goes up or down, like maybe like 10 cents, 50 cents, and I'm green on the premium. So say my premium goes up, then I'll start scaling out just like normal shares. So if I'm buying a penny stock and it starts going up like 10, 20 cents, that's when you want to start scaling out. And I do the same thing with options. If an option goes up, I start scaling out. So I don't really care if they're in the money or not, because I'm just looking at the direction they're going. So basically with options, all you need to know is the direction. If you're day trading them, if you're swing trading, that's a different story. But day trading, you just need to know the direction of options, and especially in like Monday through Wednesday, if you see like, say this is a support line, right? So I told you guys about support and resistance. So say this is a support line, you think the stock is going to go up, you're going to go to the options and you're going to go to the calls on the left side. And ideally you do not want to go more than 5 out of the money. So this is 1, 2, 3, 4, 5. It really depends on the stock. Some of these will be worthless, like even like the fourth or like the third or fourth will already be worthless, especially more towards the end of the week because they're closer to expiring. But if it's a Monday, Tuesday, Wednesday, I usually look for like 3 or 4 out of the money. If it's like Thursday, I'll look for like 1 or 2 out of the money because they're usually cheaper. If you think it's going to go up and you're trading an option on Monday, so say you see a balance, you think it's going to go up and it's at $69. You could buy a 70 contract, you could buy a 71 contract, or you could buy a 72. It doesn't really matter. There are ways to look at other things like implied volatility, open interest, and the volume on these, maybe to influence your decision. But I don't look at any of that, but I will explain it next video. I literally just pick whatever I feel like or whatever one's cheaper for me. And sometimes I go a little cheaper so I can buy more contracts so then I could scale more contracts and leave some more runners. But we'll do scaling in another video. So if you think it's going to go up like on a Monday or Tuesday, Wednesday, whatever, I usually go like 1, 2, 3 out of the money. I like this $39 is pretty cheap for next week. So maybe Monday I'll look at that if I think it's going to go up. Ideally, I'm looking for this to break 70. That would be my trigger. But if it does break 70, maybe I would go with the 72 call option and I would buy a few of these. And it doesn't matter if the price goes to 72, as long as it goes from 70 to like 71, 70 to, even if it goes from $70 to $70.10, this premium will probably go up like 0.01 or 0.02, so it'll go up $1 or $2, so you're still going to be in profit. But if it's like a Thursday or Friday and they're close to expiring, these are likely not to go up and they're already going to be worthless. But like I said, I'll explain in the next video. That's basically all you need to know. If you know the direction of the stock and you know how to play options, you can literally just, most of these will go up depending on what day it is. But I really can't explain why what day it matters yet. I'll explain with the Greeks. There's something called theta. I'll teach you guys about theta next week, and that's why they're much more risky than shares, because they lose value. Unlike if you bought shares in a company, those do not lose value because they're just shares. Like nothing affects them, right? So that is basically it about options. I'll go over open interest, implied volatility, and other stuff next week, and the Greeks as well. And the key thing to take away from this video is if you know the direction of the stock, just play the trend. Like buy a call if you think it's going to go up, buy a put if you think it's going down, and generally go like 1 or 2 out of the money, and likely those premium prices will rise if it goes up. So you'll start to, if you guys don't play options, you'll start to learn how fast or slow they go up depending on the day or depending on how out of the money go. If you buy in the money options, like these go up much slower than these potentially could, because these already have a lot of value, and there's something called intrinsic and extrinsic value. I'm not going to get into that. That's pointless. You don't really need to know it. And same with exercising. You don't not need to know what exercising means, because like I said, people only trade premiums on this. So think of these numbers as like share prices, like the bid and ask for share prices, except multiplying by 100. So that's basically all you need to know. Hope this video helped. Let me know if you guys have any questions. This is probably really confusing because I was really confused the first time I learned options. So please feel free to DM me or just put something in the Twitter replies and I'll definitely be sure to answer. All right, hope you guys have a nice night, and I'll be doing another one of these tomorrow for you guys. And lastly, make sure to use my Webull code. It's in the description. Tell your friends about these videos if they need assistance with getting started with trading. Like, comment, subscribe, turn on notifications, all that, and peace out.